So section 7.2 is going to go through how you prepare a statement of owner's equity and a balance sheet. So the statement of owner's equity basically is going to be a document that's going to have you bring your capital account up to date for the end of that fiscal period. So we know that a net income is going to increase capital, and drawing, which is the money the owner takes out of the business, is going to decrease our capital. So the capital that's shown on the worksheet is the capital amount that from the beginning of the fiscal period, and then anything that's been added in if the owner adds more money invests more money into the business or anything like that. So at the end of the fiscal period, we have to take whatever the owner took out of the business, the drawing account, out of capital, and we have to add in net income or take out a net loss. So that's what preparing the statement of owner's equity does for us. We get the information for this statement from the worksheet, again, from the balance sheet columns. We take the capital account, the drawing account, and the net income. So just like all the other financial statements, we prepare that heading. The first line of the heading is the name of the company. The second line is the name of the statement. This is called a statement of owner's equity. And again, because it covers information from the beginning of the month to the end of the month, the date is for month ended with the last day of that month. Then it's a really simple form to do. First line, again, we have two columns. Again, just like the income statement, these are not debit credit columns. They are total and not total columns. So the first line, you're going to put the name of the owner and capital at the beginning of the month, and that balance goes in the total, the far right column. Then you're going to take your net income, put it in this first column. You write the words less and then the owner's drawing account, and you put that there, and you're going to subtract that. So basically, you're going to subtract out what the owner took out of the business from the net income, and that total goes on that same line in the second column. And then when you add in what's left, because this is net income minus the drawing, so this is the gross of what they're going to add back into the capital account. You add those two together, and that gives you your updated capital account. This is the amount that you're going to use on the next statement, which is a balance sheet. If you had a net loss, then instead of subtracting drawing from the net income, you would add drawing and net loss, because both of those amounts are going to decrease capital, and then you would subtract them from a capital account. So on here, it would say net loss plus drawing. You would add those two amounts together, put it over here, and then subtract. Okay, so balance sheet. As I've talked about before, a balance sheet is a financial statement that tells us whether our accounting equation is still in balance. This is going to be for a specific date. And what a balance sheet does, shows us the financial condition of a business. So the income statement shows us the progress of the business. The balance sheet shows us the financial condition of the business. And that basically tells us whether our business is strong or is not doing so good and needs to make some changes. And it is on a specific date, because if you do this on, say, the 31st of December, and you do transactions on January 1 or January 2, those balances change. So again, just like all the other ones, we're going to get this information from the worksheet. This time it's going to come from the balance sheet columns. So you get the account titles from the account title column. And again, this is a balance sheet. So these are the accounts that tell us whether our accounting equation is still in balance. Assets, liabilities, and capital, or owner's equity. The amounts come from the balance sheet column. That's important because we had our trial balance columns, then we had our adjustments, and supplies and prepaid insurance are impacted from the adjustments, So we want to take the new balances that are showing in our balance sheet column. So that's really important that you get them from those two columns, not your trial balance columns. So again, the heading, first line is going to be the name of the company. Second line is going to be the name of the report. This time, because it's for a specific date, you do not put the words 4 month ended. You just put the date. This form looks a little bit different. We have a left side and a right side. So similar to our accounting equation, assets are on the left, liabilities and owner's equity are on the right. So you center the heading assets in the left column, then you list all of your asset accounts and their balances. Then you're going to come over to the right side and you're going to center the word liabilities on the first line. And you're going to list your liability accounts and you're going to add them together to get total liabilities. Then you're going to center the words owner's equity underneath your total liabilities. And you're going to list your capital account. Now, this amount is the amount from your statement of owner's equity. It is not the balance that's on the worksheet. We took the statement of owner's equity, we took the current capital, added in the net income, took out the drawing to get the current capital, and that's the amount you use on the balance sheet. Now we know that our accounting equation is assets equals liabilities plus owner's equity. So now you're going to take your total assets, you're going to add those up. The reason you wait to add up the total assets is because everything has to be in balance. We want the total assets amount to be on the same line as the total liabilities and owner's equity. So you add up your total assets, then you come over to the other side and you're going to write total liabilities and owner's equity on the same line as total assets. So you may have to skip a line or two. And then you're going to add your total liabilities to your capital to get your total liabilities and owner's equity. These two amounts should equal and should be in balance. If they are not, then you've done something wrong. Going back to how you find errors, most of the time, if these two do not add up, it's because you've used the wrong capital amount on the balance sheet. So that's always going to be the first thing you're going to look at is, did you use the amount of capital from the statement of owner's equity? If you didn't, then they're not going to add up. Then you want to go back and make sure you brought all the accounts over correctly, that you added correctly and all of that stuff. Because the whole point of this statement is to show that our accounting equation, assets equals liabilities plus owner's equity, is still in balance. If they do balance, you double rule to show that they are in equal and in balance, and that's how you do a balance sheet.